What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. And this episode, I'm going to be sharing the 5 attributes of a holy grail multifamily deal in our business. And put in another way, basically the 5 attributes of a deal that signifies this is going to be one that we really want to pursue. And when we see a deal that boasts these 5 attributes or has a large number of them, we're typically going to aggressively pursue that deal, and it's likely a deal that we want to buy, fundamentally speaking. And I think that my goal in this episode is for you to start looking at deals in your multifamily business through this lens and start to try to define deals as it relates to what attributes do they have, how does that align with the types of deals I'm looking for. And if you're a value add investor, you're probably going to be looking for deals that have the same attributes as what I'm going to be talking about today. A little bit of housekeeping. So I know I've been releasing a ton of solo episodes on the podcast feed recently and have been doing less guest episodes. Frankly, that's been a function of my time commitment to the core real estate business being much higher over the last few months as we've been launching our newest funds, as we've been making some key hires and basically implementing some growth initiatives in our property management company and just kind of managing all of the deals that we've had in the business, which is a good problem to have, but has pulled me away from doing as many guest episodes as I've historically done on the podcast. I will say moving forward, I'm going to be placing a much larger emphasis on bringing on guests and returning to a nice balance between the solo episodes as well as the guest-oriented episodes. So keep an eye out for those episodes, I should say, with guests here over the next couple of months and into the future. Additionally, we're going to be launching, and we may have already launched it by the time this episode goes live, the second round of funding for the New Hampshire Multifamily Fund 3, which is our fund that we're using to acquire small to mid-sized multifamily properties throughout New Hampshire. Basically, a vehicle that we are using to raise capital and then to convert and buy the deals that we're finding direct to seller and through our extensive relationships up in New Hampshire. So if you'd like to learn more about how you can participate in that fund, if you're an investor, click the link in the show notes, probably link to the deal room or something along those lines. But with that being said, let's actually get to this episode. So as I mentioned, we're going to talk about the 5 attributes of what a holy grail multifamily deal looks like to us, our most ideal multifamily deal. I actually released an episode on this topic, I believe it was late 2024, so almost a year ago. And in that one, I shared 4. However, it's changed a little bit since I released that episode. And in this one, I'm going to be expanding on a couple of the concepts that I touched on at a high level about a year ago. So if you think this is a repetitive topic, I'm here to call out that it's not. And we're going to be getting into some new stuff here. And this is what this looks like in our business today. So attribute number 1 is a deal that requires minimal renovation dollars or minimal CapEx dollars on the major systems, but where the majority of the CapEx budget is spent in unit or on value add renovations. So again, when we're pursuing a multifamily deal, we want to be compensated as much as we can through implementing a business plan for our knowledge and our experience versus swinging a hammer. And that's most easily done by spending less renovation dollars to achieve your desired rents. So for example, let's say you have 2 buildings, one building you have, let's just say they're both renting for the, all the units are renting at the same rental amounts, kind of have the same quality of tenants, and they're in the same market. But one building, you're going to have to go in there and you have to do your apartment renovations and you're going to do your flooring and your kitchen and all that. And then the other one, you have to do same thing, all of your apartment renovations, but the roof's also dated and the electric panels are pretty screwed up and the siding's a little wonky and maybe you got to paint the siding and you got to do something pretty soon. Obviously, both of these deals, right, you want to pay less for the one that requires less systems CapEx or systems related CapEx. But even if you are getting a better deal, let's say you're paying, a price that accounts for that, for what you're paying in or what you're going to need to spend in the renovation dollars to do all those major systems CapEx, you're accepting a lot more risk in that scenario because, again, you're still sending more money out the door and there's still a higher likelihood that something can go awry, right? You take off all the shingles on the roof and you realize, oh, you actually got to put down some new plywood there because some of it's rotted or whatever, right? And it's hard and you didn't budget for that. So long and short, we want the vast majority of our renovation dollars to be spent on value add renovations, which is renovating units, common areas, and then doing exterior updates that again add value. And typically that's through the lens of it increases the curb appeal. So we're doing like, landscaping or we're painting a front porch. But again, usually that stuff is just lower dollar amounts than it is to go in there and replace the heating systems or the roof or whatever. The roof, the heating systems, the plumbing, the electrical, none of that stuff makes it or allows you to charge more in rent or increases your NOI, other than maybe you're getting some repairs and maintenance efficiencies. But at the end of the day, it doesn't allow you to push rents, push NOI. So when we're looking at a deal that has, low rents, it meets all of the other attributes that I'm going to talk about in this episode, and it doesn't require us to spend a bunch of money on non-value add CapEx, we get really excited. Attribute number two is poor management quality or just lack of management sophistication. And there's a whole bunch of sub bullet points underneath this. I'm just going to rattle some off. Number one, maybe the current owner or the seller is not charging any fees of any kind. Maybe they're letting this tenant use the garage or there's storage areas that they're letting the tenants use. Maybe they don't allow pets and therefore they're not able to charge pet rents. Maybe there's some other way that you can monetize the lot in a way that allows you to charge, some ancillary fees above and beyond just the base rent. Maybe there's a ton of parking, enough to provide a space, a unit, or whatever the number might be included in the rent. But there's a whole bunch of extra parking that you can then rent out to the residents if they want extra parking spaces. So first thing first is we look for fees, other income, and then we start to think about things above and beyond that. Are they just not doing an effective job from a lease renewal standpoint, and we got a bunch of month-to-month tenants, and they want to stay, and we have an opportunity to kind of push rents and get them on better lease cycles. Maybe they are paying utilities that they don't need to be paying because they're separately metered, but they just did it because they thought it would be easier. We've seen all kinds of different things here. But basically, you want to start looking at opportunities to create ancillary income to increase the resident experience at the property itself. Let's say that there's only one dumpster at the property and the building should, probably needs two dumpsters or something like that. And you can just add another dumpster. Yeah, you're picking up a little bit more in vendor expense there and contract services, but maybe you're allowed to charge a little bit more in rent, or you're increasing resident satisfaction, therefore you're increasing renewals, et cetera. And there's some downstream, implications there. So high level is just poor management quality because that's easy to fix, right? That's just downloading your knowledge onto a situation and your experience, again, versus exchanging dollars for ideally future dollars, which is what you're doing when you're renovating. Number three, and this is, kind of a byproduct of poor management, but just low rents. Low rents with an owner that isn't incentivized to push them because they're comfortable with the current situation at the property. And a little bit of a, kind of addition beyond that is low rents, but a resident base at the property who is, one, willing to pay higher rents if we provide a better living situation there, and two, that already aligns with the class of tenant that we want at the building. So, for example, let's say you have a C-class building in a B-class area, and your goal is to do some type of large renovation program and then start leasing to a B-class resident. Oftentimes, you're going to have some challenges there if you're totally updating the class of resident in a building because, maybe you're accessing a unit right after closing, you're trying to lease to this target resident, but they don't really want to be neighbors with this other type of resident, right? And that can create some complications from implementing a business plan standpoint. The ideal thing is you already have a class of resident at the property, but you're trying to bring in other people that already fit that demographic and that kind of makeup of the building itself so that you're not dealing with management challenges there. The highest and best, or I should say the deals that we pursue at the highest level are also the ones where the residents at the building are just willing to pay more. And I think there's oftentimes so many situations where a tenant or a resident, they kind of know that they're getting a good deal. Like most know. Pretty much every resident, because they have friends who are renting. They probably look at Zillow when they're bored on a Tuesday night. When lease renewal time comes and they're thinking, oh, I don't know if my property management company is going to renew my lease, they probably just start looking to just get a sense. So most of them know that, yeah, maybe they're paying $1,200 for a $1,600 a month apartment or whatever it is. And they'd be willing to pay more to stay there, especially if the new owner comes in and paints the common areas and does some nice landscaping work and, addresses some of their maintenance requests and all this stuff. So that's also who we want to find. And that can be a little hard to notice or identify during an early walkthrough or just in an early conversation. But oftentimes you can get that sense based on how people are living and based on the class of property, etc. Holy Grail item number four, attribute number four, is a favorable unit mix. Now, a favorable unit mix is going to be different in different markets. I'm going to take two logical extremes. Let's say you're in a rent controlled market, San Francisco, LA, I don't know. I have some folks in my network that invest in markets like that, and they actually really like pursuing buildings with smaller unit mixes, one bedrooms and studios, because they just organically turn over more often, right? The tenant who moves into the studio is probably not going to stay there for 10 years. They're probably going to move out in a few years and move in with a roommate, a girlfriend, buy a house, whatever, boyfriend. It's basically a more transient living situation. And they're actually welcoming that vacancy because it allows them to reset the price when they go take it back out to the market. It reduces the risk that for some reason the rent control falls behind, inflation or whatever. Now, the other extreme is kind of what we like to look for in our business is high bedroom count units, twos, threes, fours, because typically we're going to be leasing to families or large co-living situations with roommates or something along those lines. And typically you retain those residents for a longer period of time. Typically the average length of stay for a tenant who's living in a three bed, assuming the same submarket, is going to be considerably longer than the tenant occupying a studio or a one. Now, in those situations, we're able to underwrite slightly lower vacancy rates over a longer term hold periods. And that obviously flows downstream to less turnover costs, less loss of revenue due to vacancy, lower repairs and maintenance, again, because oftentimes those costs get lumped into turnover. And it's a much more predictable type of property to operate. Holy Grail number five, and this is kind of a real nuanced one, something that I think we can start to tell a little bit better in our business now as we have more discussions direct to seller, is a seller who is just collaborative or at least not combative. And there's a few reasons why we look for this. One, it's just much easier to do deals with an easy seller. Maybe not someone who is going to fight you on every single little trivial deal point, someone who's willing to work with you throughout the process, someone who's going to give you all of the due diligence materials you ask for in a timely manner. More specifically, what this can bear out to in an actual transaction is one who is willing to give you a longer closing timeline, or where they're not pressed from a closing standpoint, because that might allow you to get better debt terms. It might allow you to, or due to the fact that you can shop it out, it might allow you more time to go out there and raise capital if you're going to go raise capital for the deal. Maybe they're willing to be a little bit more creative in the deal structure. Seller financing is obviously a big one here, but maybe they're willing to do some other stuff where, add some stuff to the additional provisions where they'll try to renew the leases with legacy residents at some higher price before closing to assist you with your lending or to give you a head start on your business plan or whatever. Basically, just a collaborative seller who is willing to help you through the deal, not in terms of like helping you do things in terms of actually closing it, but actually who's willing to get a little bit more creative and a little bit more helpful in the sense that they're just not going to fight you on every little thing. This is something that we've noticed more and more as we do more deals and we've been in the business for much longer. But it is, I think, an attribute of a deal that we really want to pursue. And it makes doing deals far easier when you have a seller like that on the other side of it. So again, in recap here, the 5 attributes of our Holy Grail multifamily deal. Number 1, minimal systems CapEx required, where the majority of our renovation dollars are going to be spent on value add renos. Number 2, poor or unsophisticated management in place, maybe no fees, poor maintenance of the building from a vendor standpoint, etc. Number 3, low rents, but a tenant base that is willing to pay more if the building is nicer. And 2, already aligns with the residents that we're going to place when we start turning units. Number 4, a favorable unit mix, however that's defined in your market. Number 5, a seller who is collaborative or at the very least not combative. Hopefully this helps all you guys out there pursuing deals better classify where you should be spending your time and the types of deals that you should be looking at. If you haven't already, check out the New Hampshire Multifamily Fund 3 with a link in the show notes. And also, we're coming up on 300 episodes. I am hoping that we can get to 300 reviews before episode 300. It's a little bit of a goal that I've got. I believe we're at 295, 296 right now, so just need a few more. If you've learned anything from this podcast over the years, it takes you literally 2 seconds to just leave a 5-star review. So if you do, I appreciate you. Thanks to everyone who has in the past. But I appreciate you all for listening, and I'll catch you guys on the next episode.